Well, let's get into our conversation now. In a decisive move to curb inflation and stabilize the economy, the Central Bank of Nigeria has increased the monetary policy rate, otherwise known as MPR, by 400 basis points to 22.75%. This unprecedented adjustment marks a significant departure from the previous rate of 18.75% since July 2023. The committee said this aggressive stance was primarily influenced by the urgent need to address the ongoing inflationary pressures, the volatility in the exchange rate, and the anticipation of further inflation coupled with the rising inflation expectation. Well, so what does this mean for the economy, and what does this mean, and of course, the impact of these on livelihood? I'm joined by the president of the Association of Capital Market Academics of Nigeria, Professor Uche Waleke. He joins me from Abuja studio. Thank you, Prof, for joining us.
Thanks so much, Frank, for inviting me.
All right. Take a look at this decision announced by the CBN Governor, Cardoso. Of course, it's the highest in the history of the bank. What's your understanding of this aggressive move, and how does this affect the economy?
Yeah, first is to note that the decision to tighten was expected. It was predicted that against the backdrop of elevated inflation, against the backdrop of liquidity surfeit, we read that money supply, for example, broad money supply, increased from about 70 trillion in December to over 90 trillion in January. So when you have this kind of liquidity in the system, of course, it's bound to fuel inflation, particularly when it is not tied to productivity. By the way, monetary policy essentially is what you do to, well, you're targeting inflation, your final target, but the intermediate target is usually money supply. You try to control the volume of money that is out there. Essentially, that is the primary function of the central bank, as specified in Section 2 of the CBN Act of 2007. So it's understandable when the central bank is worried about rising inflation, is worried about rising exchange rates, persistent fall in the value of the naira, and of course is putting in place or using tools at its disposal to deal with that. So again, the tightening was expected, but what was not expected, what came as a surprise to many of us, was the magnitude of the tightening. It was too, if you like, the increase was too steep, and I had described it in a previous interview. I had described it as an overkill, and that's because of the potential to also distort a whole lot of things in the economy, its potential, its adverse consequences, especially on growth. This is an economy that is still struggling to grow, to at least maintain or sustain strong growth. The last GDP growth rate we had in 2023, GDP came in at 2.74%, down from 3.51% in 2022, and again from 3.54% in 2021. So with this kind of decline in outputs, with rising unemployment, even the NBS, if you use their new methodology, is also talking about increase in unemployment rate. So when the government of the day is concerned about reflating the economy, the government of the day is concerned about stimulating growth. It's concerned about enabling businesses to have access to credit. Recently, the government was talking about introducing consumer credit, introducing for students, student loan scheme. So, against the backdrop of all of these efforts, one would expect also that the central bank should, be conscious of that and put in place policies that are in alignment with, those fiscal initiatives. I think the idea of raising the MPR by as much as 400 basis points, would seem to counter this, because it has implications for businesses, for access to credit. It also has implications for even the asset quality of banks. I'm speaking particularly with reference to non-performing loans. Today, the non-performing loans is still within the CBN threshold of 5%, so that's good. But this can also, put it at risk or put it in jeopardy, because by the time banks begin to reprice their loans, by the time interest rates, interest on loans begin to increase, you should expect default rates may also rise. Okay. And I don't also need to tell you the obvious impact it has on the stock market. Of course, it's already, even before the meeting, because of the anticipation that rate hike was going to be the decision, the profit-taking sentiment already turned negative in the market. So it has a lot of consequences, adverse consequences for the economy, the way it has been done. It's not as if tightening is not proper. Tightening is ideal at this moment, but it has to be measured. That has always been my argument. You approach it in a measured way, such that the distortions, are not, too significant.
We'll talk about the implications of these one after the other in a moment, but there's a cry on the street, Prof. There's a cry on the street of Nigeria over high cost of living, high cost of food prices, and protests across the state of the Federation, even as the federal government struggles to quell these challenges. How is the MPC decision likely to address the root cause of these challenges? With this aggressive move drive down inflation, since this is about driving down inflation, right? And if not, at what benchmark rate will be fine to address the inflation rate?
Yeah, so, yes, I agree with you. It's about driving down inflation, but the question is, what are the drivers of inflation? Okay, theoretically speaking, we say there are two major types. It's either demand pull or cost push. Okay, you have a situation in which cost of production is driving inflation in Nigeria significantly. Even the MPC communique acknowledged that. It talked about rising, cost of energy. So when you have high cost of production driving inflation, if you jack up interest rates, so much, of course it impacts cost of production. I've just told you that monetary policy works through several channels. You have the interest rate channel, you have the credit channel, you have the exchange rate channel, and then you have the asset channel. That's the stock price, the stock market channel. Now, talking about the credit channel, when you you raise monetary policy rates. Okay, one of the things it does is, of course, to also increase the rate at which banks lend to the real sector. Monetary policy rate, by the way, is meant to be the anchor. So it's the rate at which the central bank lends to commercial banks. So when you jack it up, okay, it translates to also increase lending rates, in the economy. And when the credit system is squeezed such that the real sectors are not getting credit, the informal sector is not getting credit, even aside from the banks. Okay, so when that happens, what becomes of output? You find that the cost of production, because interest rate is high, cost of funds, cost of capital is high, that also has a way of being translated to higher cost of production. And I just told you now, high cost of production is one of the challenges, one of the major factors driving inflation. It's not just about money supply, but there's also the issue of cost of production. So, and that is why in all of this, it's important to maintain a balance, to recognize that there's also a level to which you raise interest rates and it becomes counterproductive, because by the time the effect transmits through the economy, it ends up also having rising cost of production and then fueling the inflation that you set out to tame, or you set out to tackle. In a nutshell, Frank, you see, this inflation challenge we have in this country is not just about the central bank alone. The fiscal side too must come in, given the supply side factors, structural factors over which the fiscal side has control. The monetary authorities don't have control over insecurity, for example. Because if you look at even if you read that communique by the central bank governor, it talked about 4 factors, 4 major things that drive inflation. It said security challenges in food producing belts. It talked about high fiscal deficits. Again, that's not within the purview of the central bank. It talked about rising energy cost. That's not the purview of the central bank. The only one that's within the purview of the central bank is the exchange rate pass-through, which the CBN governor mentioned. And I must also to be fair, I must commend the central bank, with respect to what they have done so far to bring down the exchange rate and to also calm the market and ensure that the international value of the naira, is restored. That's speaking to measures like the beginning with even ensuring that all valid backlogs are cleared. I think that is one effort, a step in the right direction. The limit on margins by by the international money transfer operators, which they removed. The issue of enforcing net open position for banks, and more recently, the exposure drafts with respect to the BDCs, which they released. I think these are measures meant to drive down the exchange rate. So on that score, the central bank should continue to intensify efforts to ensure that exchange rate comes down because, again, of its impact on inflation. But the monetary policy rate is simply but one tool that central banks use to, tackle inflation. So there are other tools, and that's why I think emphasis shouldn't be on that monetary policy rate because of its, it has the potential to also distort other things in an economy such as ours, ours where inflation is not only driven by monetary factors but also by monetary factors. These other tools include open market operations. Even before this meeting, the MPC had missed September and November meetings. But since then, of course, the central bank had also been tightening using these other tools, open market operation, for example.
Let me quickly comment, Prof. Just a few things we need to touch on before I will let you go. You spoke about the need for fiscal authority to start playing their part. What role do you think they can start playing now, complementary to what the CBN is currently doing? And I also want you to speak. You spoke earlier about the fact that you were surprised that the interest rate was jacked up by 400 basis points. So talk to us about how the economy is going to react to this, even down to the man in the street. You talked about the fact that the cost of production is going to go up. So obviously, this is going to be transferred to the man on the street. So speak to us how economy is likely to react to this. And secondly, talk to us about complementary role from the fiscal side of things.
Yes. Well, it's not difficult to see how the response would be. As I said, you should expect banks to begin to even write to their customers now, telling them about increase in rates. So when rates increase, as I said, you also what do you do as if you're a firm? You pass it on to the final consumer. So it ultimately will also lead to increase in cost of production. And it will also even reduce access to credit. So in terms of expansion, for example, those that are looking for funds to expand, want to borrow to expand, of course that will negatively affect it. And of course, ultimately, it is the man on the street that will also bear the brunt when cost of production is also affecting the general price level. All right. Now talking about the fiscal side. Okay, well, but before the fiscal side, let me also say this. You see, the MPC didn't just increase the MPR by 400 basis points. they also increased the cash reserve requirement from 32.5% to 45%. So when I used the term overkill, that's also what I was referring to. Okay, 45% cash reserve requirement is way too high for the banking industry. You see, in other climes, you will have differentiated cash reserve requirements, but for us here, for most of the banks, it is just the cash reserve requirements, one that applies, maybe apart from the non-interest banks. So it's high. And when you look at what also obtains in sub-Saharan Africa as a whole, in terms of cash reserve requirements, ours is about the highest, or among the highest. And you also know the effect of cash reserve requirements on the ability of banks to even perform the intermediation function or to grant credit. It constrains them, because that reserve is more or less sterilized in the bank, in the central bank, and is not remunerated, which is why some people also see that as a form of tax. Okay, so I think the central bank or the MPC, could have also left that CRR at 32.5%, especially when it is clear. They have told us that they're also meeting next month. In March. So if you're meeting in a few weeks' time, why don't you approach this in a gradual way to also see the effect of the one you have done? If you're not satisfied, you can also take further positions by March. But to start it in one fell swoop, by the magnitude that it has been done, that's just my concern. On the fiscal side, of course, just as I told you, there are supply side factors that the central bank cannot control. So the fiscal must also complement what the central bank is doing in the area of security, in the area of energy. Okay, there's need for us to begin to work towards refining, ensuring that we stop importing petroleum products. We refine our products here. If our refineries are working, I don't think pump price of fuel will be as high as it is today. So these are the areas that the fiscal authority should come in, okay, to ensure that the insecurity does not prevail to the point where farmers cannot go to farms to work. And that's why you find today, even the inflation rate we are talking about, is a food index that is where the pressure is. Pressure points is on food, and because of the insecurity that we all know is the issue, especially in the food producing areas. You have this food problem. So it's not the central bank that will deal with that. It's not the central bank that will deal with rising cost of energy. It's not the central bank that will deal with high fiscal deficits at all levels of government when they have borrow. Okay, especially with this increase in FAC receipts. So as long as the fiscal side is working to complement the what the central bank is doing, that's the only way you can have inflation rates really come down. And that's why I want to support the idea now, which being championed by the National Assembly, in their bid to amend the CBN Act amend the CBN Act of 2007 to include a coordinating committee between fiscal and monetary policy, okay, to provide that in the Act. I think it will go a long way to ensure that both the fiscal side and monetary side, are talking to each other, and that there's synergy in what they are doing. I say this because if you look at what the good work the Taiwo Oyedele Committee is doing in the area of streamlining taxes, trying to ensure a friendly business environment. Okay, it's only when businesses thrive that they can be in a position to pay taxes. But when the monetary authority too is trying to constrain that that effort, of course, what you get will become suboptimal. That's why I feel the two must work together, talk to each other, to be able to achieve the macroeconomic goals of low and stable inflation, of sustainable GDP growth, and of course low unemployment rate.
Well, I think a good place to leave it there. Thank you so much for your time the president of the Association of Capital Market Academics of Nigeria, Professor Uche Walike. A good time to leave it there. Thank you so much for coming on Business Nigeria.